Hey everyone! Welcome back to our Complete Wellbeing channel. I hope you're all doing well. In the series of basic personal finance videos, this is the third part. In the last two videos, we discussed budgeting basics and emergency funds. If you have missed those videos, please click the link given in the description section below this video. Today, we've got a topic that can significantly impact your financial journey. Yes, the topic is understanding credit scores and building credit. So, if you're looking to unlock financial success, you're in the right place. But before we get started, if you find value in content like this, don't forget to hit that subscribe button and ring the notification bell to stay updated on our latest videos. Now, let's jump into it.
Have you ever wondered how credit scores work? Well, credit scores, in the simplest terms, are like your financial report cards. They're a measure of your financial health, and they play a significant role in your journey towards financial success. Let's imagine for a moment you're planning to buy your dream home or maybe a new car. You'd probably need a loan, right? Now here's where your credit score comes into play. A good credit score can make it easier for you to get approved for loans, often with lower interest rates. It doesn't just stop there. Your credit score can also influence credit card approvals and even job applications in some industries. Yes, that's how important it is. So it's clear that understanding credit scores and knowing how to build a good one is crucial to unlocking financial success. In the next few minutes, we will demystify the concept of credit scores and provide you with a step-by-step guide to building a good credit score. Credit scores at first glance might seem complicated, but they follow a straightforward system. Let's unravel this mystery together and understand the anatomy of a credit score. First, let's talk about payment history. This is the most influential component of your credit score, making up about 35% of the total. It reflects whether you've paid your past credit accounts on time. So if you're punctual with your payments, you're off to a great start. Second, we have credit utilization, which is the ratio of your outstanding credit card balances to your credit card limits. It makes up about 30% of your score. Lower utilization rates reflect positively on your credit score, so it's wise to keep your balances low. Next, we come to the length of credit history, which accounts for about 15% of your credit score. It considers the age of your oldest account, the age of your newest account, and an average age of all your accounts. Generally, a longer credit history will increase your credit score. Then, we have new credit, which makes up about 10% of the total score. This considers how many new accounts you have. It's not just about how many new accounts you have, but also how long it's been since you opened a new account. Opening too many new credit accounts in a short period of time can signify risk and may lower your credit score. Lastly, we have the credit mix, which also makes up about 10% of your score. This considers the different types of credit accounts you have, like credit cards, retail accounts, installment loans, mortgage loans, and finance company accounts. It's good to have a mix, but this doesn't mean you should open accounts just to have a better mix. It's more beneficial to manage the credit you already have responsibly. So as you can see, several factors play a role in determining your credit score. Understanding these components and how they affect your score is the first step towards unlocking financial success. Now that you know what makes up a credit score, how do you build a good one? Let's dive into the first step, ensuring regular on-time payments. Think of your credit score as a financial reputation. Just as your reputation is built over time through your actions, your credit score is shaped by the way you handle your credit. Regular on-time payments are the backbone of a good credit score. They reflect a positive payment history, showing lenders that you can be relied upon to fulfill your financial obligations. Every time you make a payment on time, you're demonstrating financial responsibility. This contributes to a positive payment history, which accounts for a significant portion of your credit score. On the flip side, late or missed payments can negatively impact your score. So the key takeaway here is make your payments on time, every time. This seemingly simple step can go a long way in building a strong credit score. Remember, consistency is key when it comes to payment history. Moving on to the second step in building a good credit score, This step revolves around the concept of maintaining a low credit utilization ratio. Now, you may be wondering, what exactly does that mean? In simple terms, your credit utilization ratio is the percentage of your available credit that you're using. For example, if you have a credit limit of $10,000 and you've used $2,000, your credit utilization ratio is 20%. To maintain a low ratio, it's crucial to pay off your balances regularly and avoid maxing out your credit cards. Another strategy is to request an increase in your credit limit, provided you don't see it as an opportunity to spend more. Remember, it's not about how much credit you have, but how responsibly you use it. A low credit utilization ratio will show lenders that you're responsible with your credit. The third step in building a good credit score involves your credit history. Your credit history is like a financial fingerprint, unique to you and you alone. It tells the story of your financial habits over time, including how you've managed credit and debt. The importance of a long credit history cannot be overstated. Lenders want to see that you've been able to manage credit responsibly over a significant period. It's not just about paying on time, but demonstrating consistency over the years. So, how do you build a long credit history? One way is by keeping old accounts open. Yes, even that credit card you got in college and hardly ever use. Keeping it open, even if you're not actively using it, contributes to your credit history length. Remember, this isn't about accumulating debt, it's about showing lenders that you're capable of managing credit over the long haul. A long credit history provides lenders with a clearer picture of your credit behavior. The final step in building a good credit score involves diversifying your credit. This might sound a bit complex, but it's simpler than you think. Now, what does diversifying your credit mean? Well, it means having a healthy mix of different types of credit in your portfolio. This includes both revolving credit and installment credit. Let's break it down. Revolving credit refers to credit that you can use, pay back, and then use again. This includes things like credit cards and line of credit. It's like a cycle. You borrow, you pay, and you borrow again. On the other hand, installment credit refers to loans that have a fixed repayment schedule. This includes things like car loans, student loans, or mortgages. You borrow a lump sum and then pay it back over time with interest. You see, having both types of credit shows lenders that you can handle various forms of debt. It's like a test. Can you juggle multiple balls without dropping any? If you can, it's a sign that you are a responsible borrower. But remember, applying for new credit should be done responsibly. It's not about opening as many accounts as possible, but rather about showing that you can manage different types of credit. Each time you apply for new credit, an inquiry is made on your credit report, which can temporarily lower your score. So, be mindful and choose wisely. Now, why is having a diverse credit mix so important? Well, your credit mix accounts for about 10% of your credit score. While this may not seem like a lot, every little bit helps when you're trying to build a good credit score. So, to sum it up, diversifying your credit involves having both revolving and installment credit and managing them responsibly. It's like a balancing act. You need to maintain a good mix without overextending yourself. A diverse credit mix shows lenders that you can manage different types of credit responsibly. So, take the time to diversify your credit and watch your credit score climb. We've covered a lot of ground today, so let's quickly recap. In our journey to unlock financial success, we first delved into the importance of credit scores. We learned that these 3-digit numbers are not just arbitrary figures, but they serve as the gateway to your financial opportunities. They're the yardstick by which lenders measure your creditworthiness, and they can significantly impact your life, from securing a loan to renting a house. We then dissected the anatomy of a credit score, revealing its 5 main components: payment history, amounts owed, length of credit history, credit mix, and new credit. Each component plays a unique role and contributes to the overall score differently. Payment history and amounts owed hold the most weight, while the length of credit history, credit mix, and new credit make up the remaining score. Our discussion then steered towards the steps to building a good credit score. Step 1 emphasized the need for maintaining regular payments. Timely payment of bills keeps your score healthy, and a single late payment can negatively impact it. Step 2 underscored the importance of keeping a low credit utilization ratio. This ratio is the percentage of your available credit that you're using, and it's recommended to keep it under 30%. In step 3, we underlined the necessity of building a long credit history. The longer your credit history, the better your score, as it gives lenders more data to assess your credit behavior. Finally, in step 4, we talked about diversifying your credit. A mix of different types of credit like credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans can improve your score. To wrap it all up, remember that your credit score is a reflection of your financial behavior. It's not just about the numbers, but about how you manage your finances. Remember, building a good credit score doesn't happen overnight, but with consistent effort and responsible credit behavior, you can unlock your financial success.
Alright, that wraps up our discussion on understanding credit scores and building credit. Remember, your financial success starts with a solid credit foundation. If you found this video helpful, give it a thumbs up, share it with someone who might benefit, and don't forget to subscribe for more valuable content. Also, post your valuable comments below so that we can improve the channel's performance. Also, watch our other videos on personal health and personal growth segments on the same channel. Thanks for joining us today on our channel. Stay financially savvy, and we'll catch you in the next video.